Hi, welcome to the Money Compass,
the show that will guide you through the world of money and finance.
with me, Emma Knights,
And me, Lucas Spiro,
exploring investments, retirement, taxes and protection,
and helping you navigate your way to financial success.
Today I am joined by Vince Keane from Blackfinch, and hopefully you can tell us lots of different things today about inheritance tax.
Yeah, good afternoon, Emma. Good to see you, and thank you for inviting me along. So firstly, just a bit of background about me, an introduction for me. So yeah, Vince Keane, Business Development Manager at Blackfinch Investments, and we're a specialist provider of tax investments, including investments that can help clients address their inheritance tax issues, or IHT as it's otherwise known. So my career in financial services dates back over 30 years.
No, can't have been that long.
Well, I know. Thank you. It's very kind. But yeah, and in the last 14 years, it's been supporting financial advisors across the East Anglia region, helping their clients in the area of tax efficient investments. Now, inheritance tax can be a really complex area, so it is important to seek professional advice from financial advisors, legal advisors, etc., when looking at the different ways in which you can kind of mitigate the tax and hopefully save you a lot of money. And one thing I just need to stress, it's important to understand that neither myself nor Blackfinch can give advice in this area. Our role is working with financial advisors who are then considering these solutions for their clients.
Most definitely. Hence why we come to you and ask lots of questions, but we're the ones that actually advise our clients and share that information and advise them on their own situation. So
yeah, absolutely.
100% agree with that. So obviously, we've mentioned IHT. What is IHT and how does it work so that people understand? Because we get lots of clients come to us that say, I think I've got an IHT problem. And some of them have absolutely nothing to worry about, yet others have this huge problem and have no idea. So I think it's kind of very unclear to people what is IHT and how it works, really. So sure. Tell us a little bit about it.
And I'll apologise now for loads of jargon and acronyms. This whole world of tax is filled with it. So I'll try and keep it simple and explain some of the terminology. But in effect, inheritance tax is paid on your estate, which is the value of someone's assets, what they leave behind when they die.
Mm-hmm.
Now, your estate will include a number of things, including your house and properties. It will include savings and investments and other assets you own. So that could be valuables, jewellery, car, etc. But there are certain things that are excluded. Certain types of pension funds, for example, are not included in that. Any outstanding debts are then deducted from this, and that calculates effectively what we call the net value of your estate. Now, not everyone will pay inheritance tax because there are a number of attractive allowances. And the main one being the nil rate band. So basically, the first £325,000 of value of your estate is not subject to inheritance tax. So if your estate on the event of death is less than 325, you're not normally going to pay inheritance tax. However, if the value of your estate is above 325, the excess is then charged at 40%, which can be quite a significant amount of tax.
I think it is that 40% is shocking to people, that they think I've paid all these taxes in my lifetime. That's a huge amount on death, but it's something that people just need to understand to realise there is planning that you can do to mitigate that as much as you can.
Yeah, absolutely. Another point just to add to that though, if you are leaving everything to your spouse, so if you're married or in a civil partnership, there's no inheritance tax to pay on first death, but obviously everything is now with your spouse. And also, if you're leaving your estate to charity, there are certain things you can leave it to where you won't pay inheritance tax.
Perfect. So that's the absolute basics of inheritance tax, but I know there's more allowances and it carries on further. So do you want to keep us going with those?
Yeah, absolutely. So there was a new allowance that was introduced back in 2015, mainly for people who own their own property and where that property is going to be left to their direct descendants. And that's typically going to be children or grandchildren. Now, property prices, you're aware, have increased dramatically over the years. So more and more people are getting caught by inheritance tax. So this residence nil rate band, as it's called, means you've got an additional allowance of £175,000. So on top of the 325, an individual potentially now has an allowance of £500,000, and therefore if you're married, your combined total is £1 million. But it is a complex area. Not everyone will be eligible for that. So if you don't own a property, you don't have children, or there's other things, it can impact that benefit. But if we give a simple example, married couple, total estate of £1.2 million. In the event of second death, There's £200,000 above that total allowance of £1 million, which if that's taxed at 40%, that would result in an £80,000 inheritance tax bill.
And when you say £80,000, that's a huge amount of money that people have worked for their entire lives that they expect to pass on to somebody else, and all of a sudden there's this bill to pay. Why would you want to pay it if you don't need to?
Yeah, and like you say, there's so many people out there that probably aren't even aware they have the issue. So it is important to do some kind of analysis on your assets. And there's other things to include in that. I mean, you could have life insurance policies. If they're not written in trust, they're added back into your estate. So it's not as simple and straightforward as it looks. But if you know about it, at least you then know there are options to address it.
Most definitely. So how much inheritance tax do people pay in the UK? Is it a big tax? How much is that?
Yeah, it's massive. And yeah, if we take last year as an example, so in the last tax year, over £6 billion was paid in inheritance tax.
Wow.
And that's the highest on record. And forecasts from the government suggest that it's going to increase again dramatically over the next few years. And it's not just the amount of tax that's being paid. More and more states than ever are paying inheritance tax. It's impacting more people.
Yeah.
And if we talk about the 325,000 allowance, well, that was last changed in 2009. And these allowances are now frozen until 2026. So for 17 years, we've seen no increase in that allowance. Okay, we've got the residence bill rate band on top. But it means that, just through property valuation increases and everything else, it's no surprise that more and more people are getting caught by this. But as you say, there are ways in which you can mitigate it. It is a voluntary tax. It can be avoided. Spending all your money would be one thing. But
and if you want to do that, then so be it.
Absolutely.
Enjoy it.
That's my plan. But but seriously though, there are things that you can do. And as I say, it's important to get advice to consider what those options are.
So I know that's obviously one thing that a lot of clients say to us about, like, they have no idea what the allowances are, and understanding that part is one really important part. But I know another thing that we get asked, I'd say on a weekly basis possibly, is what gifts can be made that are IHT exempt, and what can people do and not be causing themselves a huge liability without even realising it?
Yeah, no, absolutely. So, I mean, we'll cover off some of the basic gifts.
I do know there's a huge list of these.
There is, and I've only covered off some of the key ones. But, for example, each person can give away £3,000 per year, and that would be exempt from inheritance tax. And if you've not used your full allowance from a previous year, you can also effectively carry that forward, but you can only ever do that once. But it is important to keep records of gifts, because if your estate is assessed at the time of death, you want an audit trail there really to document and evidence what you've done.
And I think that's something a lot of people will be guilty of not doing.
Yeah, absolutely. That's more important when we come on to the larger gifts as well in a moment. But that 3,000 allowance was last changed over 30 years ago. So again, it back then...
That would have been a lot of money to give to people, wouldn't it?
Yeah, absolutely. Where now, again, it's not really kept pace with inflation. So again, it's something else that probably does feel not that attractive.
Yeah.
Now, some other gifts, for example, will be for weddings. So if your children are getting married, you're allowed to gift up to £5,000 towards their wedding. It's £2,500 for grandchildren and £1,000 for anyone else. And then there's other kind of small gift allowance. You can make up to £250 a year gifts to as many people as you want, but it can't be the same people who have benefited from those other gifts.
Right.
So they're probably some of the key ones. And the other one to mention is if you've got surplus income and you're making those gifts out of your surplus income, and it's not impacting your standard of living, then they will also be exempt from IHT. Again, important to keep the records to evidence that if it was ever looked into.
Definitely. So there is quite a few kind of things that you can do to kind of try and reduce your estate. But I suppose the previous example where they had an excess of 200,000 and they were paying £80,000 in tax, using those small gift allowances, it's going to take you a long time to burn through giving away £200,000 to reduce that tax.
Yeah, and that leads quite nicely into the kind of the larger gifts and what's often referred to as the 7-year rule. So again, many people will be aware that you can give as much as you want away, but it's then a case of how that could be impacted for your inheritance tax. So The simple rule of thumb here is that if you give away larger investments or larger amounts of capital and you survive for at least 7 years, then that would be outside of your estate and then effectively exempt from inheritance tax. But if you die within the 7 years, that amount is added back into your estate and will use up some of those allowances, meaning you'll still be paying inheritance tax on the rest of your estate.
Yeah. So even though you haven't got the money, you're still essentially paying the tax on it because it's brought back into your estate.
Yeah. So if you're in a position where you can afford to give that money away, you want your children, grandchildren to benefit from that, and use that money now, then absolutely, you want to see them enjoy it.
And I think that's much more common now. A lot of people are starting to realise that what's the point of saving all this money until I've gone? Why not give it to them now to be able to enjoy it if I can afford to do it? So it's understanding the consequences of doing that now and how it's going to impact you potentially later. Yeah,
absolutely. One of the pointers to add to that, if you're making larger gifts, and I'm talking now where the combined total of those are above your allowance of 325, what that effectively means, though, is the rate of inheritance tax you pay will start to gradually reduce once you've survived at least 3 years.
Mm-hmm.
So if you die within the first 3 years, it's all subject to inheritance tax. But after that rate of tax from 40% gradually starts to fall, only on the excess above that 325,000 though, so it's not on all of it.
So it's limited, yeah.
But it does mean, again, you can still gift larger amounts and the tax will gradually reduce. But again, it's obviously a complex area. You need to assess your personal situation through financial advice to assess whether that's going to be an option for you.
Most definitely. We've talked about what the allowances are, and we've said and kind of hinted towards there are lots of different things you can do to kind of mitigate that. What are those things? Tell us a little bit more about what you can do to help with that.
Yeah, absolutely. So, I mean, from the point of view of reducing the value of your estate, then gifting is an obvious one. So we've covered that. Another area is using trusts. And again, some people may be familiar with this or heard the terminology about I can put money into trust. Well, what does that really even mean? So trusts are often used as a way of kind of sheltering assets to protect them for future generations and beneficiaries. And it's effectively like a legal agreement where you will have this money or your capital put into a trust where you have trustees who then look after that on your behalf. So in the event of your death, they can distribute that money out to your beneficiaries. Now, the tax treatment, we'll come on to that in a moment, but it's the same for most. The same 7-year rule will apply.
Mm-hmm.
But it does then give greater flexibility with regards to that money's now kind of ring-fenced, earmarked in that trust. There's a wide range of options where you can invest that money, but crucially, you will no longer be able to access the money in that trust. The money is now owned by the trust. So if you're not keen on necessarily gifting the money directly to beneficiaries now, we could be talking younger grandchildren or whatever that may be, this is a way of actually still doing the planning, still having some control over when they may receive the benefit of that in the future.
See, so it's kind of giving you the control to look after that money for somebody else, but you're giving up the benefit of it for yourself, and that's what's helping you to basically get that IHT relief for it.
Yeah, absolutely.
So there's a few different types of trusts, and I know they're very, very complex, so I don't want us to go into too much detail and blow anybody's mind, but tell us a little bit about the different types of trust and what they're kind of used for.
Yeah. As I keep saying, and I keep repeating this, so apologies that, this is a complex area, so it's important to get the advice to consider all the different options. But if we just cover a couple of the key ones. So absolute trusts, bare trusts as they're known, is probably the most basic type of trust. And this is where, you put the money into the trust and you know specifically from outset who you want that beneficiary to be.
Mm-hmm.
So it's similar to making an outright gift. You've got this protection of the trust around it. And it means then there's no tax go into that trust. If you survive 7 years, it will be free of inheritance tax. But they can be quite rigid and not particularly flexible. And legally, the beneficiaries of those trusts can become entitled to them if they've got mental capacity or they're aged over 18. So it does have other implications with that kind of trust, but it's a very simple kind of trust arrangement.
Yeah.
Now, Discretionary trusts give much greater flexibility. And this is often used where you've got maybe a range of beneficiaries or several beneficiaries who you might want to benefit from this trust. So you appoint the trustees. So these are the people who are going to look after the money in the trust on your behalf. And they're responsible for not just managing the money within the trust, but also distributing that out, paying that out to the beneficiaries. But they do have the discretion to decide where that's going to go. It will obviously be done in line with your wishes.
Yeah.
But hence the name discretionary trust is that it's not a clear cut, oh, this is going to A, this is going to B, etc.
This person is definitely entitled to this money as such.
Yeah, absolutely. So much more flexibility, but they are more complicated when it comes to the tax side.
Most definitely. So go on, give us a little overview of what the...
Yeah, so trying to keep this as simple as possible. So if you are investing or gifting smaller amounts into a trust, it's unlikely there will be any tax on putting that money into trust. If, however, the gift is above 325,000, you could pay what's called an entry cost up to 20%. So firstly, there's inheritance tax potentially on the gift into the trust itself. Once the money's in the trust, every 10 years, there's then an additional potential for IHT if it's above those allowances.
Yeah.
And then eventually when someone exits the trust, which will be on the event of death. So yeah, it's not simple. The rules have changed on this. Well, it was a few years ago now, but it does mean for a lot of people, they will potentially limit the amount that they would want to put into that type of trust because of the ongoing tax treatment may not be favourable.
Most definitely. And I think it's really important to say as well that legislation changes all the time. So although these are the things that we're telling people today, actually that could change at any time. So again, really important to keep taking advice and making sure that you keep on top of those things. So if things do change, you know how your circumstances are going to be affected in future.
Yeah, I mean, we saw that many, many years ago now, but in the past, your 325,000 allowance, when you died, if you hadn't used it, it was lost. But then the rules changed that if you were married, that could transfer over to your surviving spouse, so they'd get the combined total of those. Now, for many, that was a big potential benefit, and yeah, you've just got to then plan accordingly and adjust for that. So yeah, everything we're talking about today is based on the rules now, and yeah, they could change in the future. So again, it's important just to keep on top of it all.
Most definitely. It's mind-blowing. I don't know how you keep up with all this.
The one thing I will just mention here, though, is that there are other types of trust which are definitely more kind of financial investment related. And what I mean by that is there are certain types of trust where, for example, you can still retain access to some of your capital. Now, the inheritance tax treatment of those is maybe not as favourable, but where you are keen to use a trust as that route, but still want to retain access to some of your capital, it is possible. And likewise, there are other types of trust where you can, from the outset, have a regular withdrawal paid to you, so like a form of income. So although you can't touch the capital, you can still benefit from the income from that trust. So again, stressing again, it's that get advice. Let's see what type of arrangement suits you best. Trusts are probably one of the most tried and tested routes to addressing inheritance tax for people, and have been around for many, many years.
Definitely. And I think whenever you hear about rich and famous, a lot of them you hear that they have a foundation or a trust or something, and quite often those things have been implemented for them to help with their IHT planning. So it just shows that people with a lot of money do tend to use them, but it's not necessarily just because they have a lot of money. It could be beneficial to people with smaller amounts, depending on what they're looking to achieve.
Yeah, it's a good point, and something I should have mentioned earlier. We were talking about kind of the annual gifting allowance and stuff. If you're making gifts to charities, I think also universities, political parties, if you have a will to do that, those gifts are exempt from inheritance tax. And one other rule change that was introduced a few years ago now was in the event of your death, where I've mentioned that you'll pay tax at 40% on that excess above those allowances. If you're leaving more than 10% of the value of your estate to charity, that tax rate comes down from 40% to 36%.
Yeah.
So if you've got kind of that desire within this, that will reduce the overall rate. So again, there's other sort of options within this depending on what your plans are.
And I think you just adding those bits in just shows the level of complexity in this area as to why it's so important to take advice and look at your situation to make sure that actually, am I doing the right thing or the wrong thing here? And is there something better that I could be doing to make sure this is as efficient as it could be?
Well, if you put inheritance tax into Google, millions of pages will come up, lots of information, and because of that, it can be quite mind blowing. So, talking to specialists who can then talk you and guide you through all of that. It's just being aware of what your options are.
Definitely. I think it's really interesting when you go and see clients as well and speak to them and they tell you what their understanding is because they've been on Google and they've read these things. And it's incredible how people interpret all of these rules in slightly different ways, which to them they think they're doing all this planning because this is exactly what Google told me to do and I know it's right, but actually interpreting it just slightly differently can have a huge impact on what the resulting tax bill might be.
Absolutely. And there is lots of jargon out there. So again, it's trying to piece through all of that as well to think like, actually, what does this even mean in English?
Yeah.
And so, it doesn't make it simple.
Perfect. So that's trust. That's one thing that you can use to reduce inheritance tax liabilities. But I know life insurance is another area. Tell us a little bit about how that would tend to work.
Yeah, no, absolutely. So another option is effectively to take out a life insurance policy where in the event of your death, it will pay out a lump sum that can be used then to pay the tax.
Mm-hmm.
So in essence, what it doesn't do is reduce the amount of inheritance tax that's going to be paid in the event of death, but it's a different way of paying for it.
So it's almost providing the means to pay that tax bill. You haven't got to find that money as such to pay it.
Yeah, absolutely. So depending on your age and your health, because often these go through kind of an underwriting process, so for certain individuals this won't be relevant because it will be very expensive.
Mm-hmm.
But for others, especially for younger people, where they're thinking, again, it could be years away before I've got to really consider this, but if I died unexpectedly, there would be a problem. So insuring against it can help towards that. Now, going back to something I mentioned earlier, it's important that those policies are written into trust, because otherwise it will pay out into your estate and compound the problem.
Just make it all worse.
Yeah. So if you've got, going back earlier, that £80,000 inheritance tax liability on death, if you've taken out an insurance policy to pay out £80,000 when you die, that money into trust can then be used to pay the tax, and it doesn't impact the residual value of your estate and your assets.
Yeah.
There are different types of insurance policy that you may want to consider. So for someone who made gifts, where it's going to take 7 years to be outside of your estate, one route is to take out an insurance policy that's for a fixed term of 7 years to cover that liability during that time. And then another type of insurance is called what they call whole of life.
Yeah.
And as the name suggests, it lasts for all of your life as long as you're paying the premiums. So again, it can be done that way. And if you're married, often they'll be set up so it pays out when the second person dies. So it's kind of on the second death when the inheritance tax is going to come into play. And again, it can be a useful way to mitigate that at that time. But again, just to stress, it doesn't solve inheritance tax.
Doesn't get rid of the problem.
No, but it's another way, and it could be quite a cost-effective way to cover it.
Definitely. So we've talked about a few different types of products, but I know your area of expertise isn't necessarily in those areas. Blackfinch actually do some kind of slightly different things. So do you want to tell us a little bit about what Blackfinch do, what the products are that you have available, and how they tend to work with regards to IHT?
Sure. So Blackfinch offer a range of solutions that invest in shares that qualify for something called business relief. This was a tax incentive introduced by the government over 40 years ago, back in 1976. I'll tell you more about that in a moment. But what these solutions offer is, compared to the more traditional kind of 7-year route to address inheritance tax, if you invest in these types of investments, they will be exempt from IHT after 2 years. You need to be holding it at the time of your death, but it's potentially a faster way to address your inheritance tax. They are just investments. So it doesn't involve a trust, doesn't involve gifts. So that also means you can retain access to your capital should you need it in your lifetime. What you take out of it is kind of back in your name, and so that wouldn't then no longer be sort of beneficial for IHT. But what remains in the investment at the time of your death, if it's been in for more than 2 years, then you would then save inheritance tax on that capital.
It's giving you much more control over your own money, and you can still access it compared to some of the other solutions we've talked about, where you're giving up either access to capital or the income or both, whereas this you've kind of got more flexibility to use it how you want to.
Yeah, absolutely. And again, caveat that it is subject to being able to get access to it as long as we can provide that, which can't be guaranteed. However, yeah, it's something that we've seen evolve and develop over the years now, where more and more people want to address IHT, but also want to kind of have their cake and eat it. In other words, we want to still retain access should we need it.
Yeah.
So just a bit of background to business relief. So when it was first introduced, it was primarily aimed at small business owners who would run their limited company, their trading company, and in the event of their death, what the government was keen for that not to happen is that be subject to inheritance tax.
Yeah.
Force businesses to close and sell. So it was a way of passing that business on to beneficiaries without the impact of inheritance tax.
Yeah.
Now, over the years, that's gradually been relaxed and extended to lots of other areas. And there are certain types of shares and companies that qualify for this, which we'll come on to in a moment. But it now enables anybody to invest in shares in these types of companies and still benefit from that tax break of holding it for at least 2 years at the time of your death. It will be 100% exempt from inheritance tax. Now, the two kind of main types of area which you can invest in, firstly, would be shares on the alternative investment market. I'll explain a bit more about that in a moment. And it's kind of the smaller company stock market, if you like, that sits kind of behind the main stock exchange.
Yeah.
Now, AIM was first launched over 20 years ago, and there's 1,000 companies who are approximately listed on AIM. So if you're investing in the right kind of company, because not everything qualifies, but you're going into kind of AIM listed trading companies, it basically means then you're qualified for this relief. So that's one route. And then the other route is going into companies that are just not listed on any stock market. So I'll refer to those as unlisted companies, but they have to be a trading company. And the important thing here is they've got to be UK-based trading companies. And that's why the government kind of reward investors, if you like, with this tax break, because it is supporting UK PLC. So, and over the past 15 years or so, providers such as Blackfinch, therefore developed a range of solutions that invest in these areas. And there's a broad range of different kinds of solution and provider out there. So we're not the only provider that does this kind of stuff. And therefore, it can be something which is going to give clients an attractive IHT benefit as well as kind of retaining access to their accounts.
Yeah, so it's kind of given the kind of retail investor access to these things where normally they probably wouldn't have access to these without a product such as yourself.
Sure, absolutely. And again, stress again the importance of getting financial advice, because they won't be suitable for everybody. And I'll come on to the kind of the key risk warnings we have to add in there at the end. But the kind of the two different strategies, there are kind of two really kind of distinct differences between the type of solution. So I've mentioned AIM. So providers such as Blackfinch will offer an AIM portfolio service where we invest you in a diverse portfolio of, say, 20 to 40 plus companies with the potential for significant capital growth over the medium to long term, but they are higher risk because they are smaller companies and therefore they will be more volatile. And another example there of how the rules have gradually relaxed. In 2013, the government then allowed those shares to be held within an ISA wrapper. So there is a common myth that ISAs are free of inheritance tax because they're
heard that one before.
Yeah, because they're tax free. So they grow tax free. The income they pay is tax free, but other ISAs would still be subject to inheritance tax on death.
Yeah.
So we now offer an AIM inheritance tax ISA. So it means you can access the AIM portfolio within that ISA wrapper, still benefiting from tax-free growth and tax-free income, but also then sheltering the money from inheritance tax in the event of death after 2 years. The alternative route, so I've mentioned AIM portfolios, longer term growth potential, but more volatile. But we also offer a solution where the focus is very much around preserving wealth with steady, predictable returns. And what I mean by that, we're targeting returns on these solutions of kind of between 3 and 5% a year. And the idea is to then just take away that kind of volatility so clients can see steady returns, still retain access to their capital if they need it, but ultimately we've got to make sure it's qualifying and benefiting from business relief. So how do we do that?
Easy, obviously, by the sounds of it.
So we'll invest here in trading companies, but they'll be doing certain things. So for example, one of the underlying trading companies we'll invest in is a renewable energy business.
Yeah.
So within there, we now have a diverse portfolio of solar farms, wind farms around the UK on the basis that they are designed to deliver those steady, predictable returns and therefore still deliver the tax break and obviously be attractive to certain types of investor. They're still going to be regarded as, and all these investments will be regarded as higher risk. You're investing in AIM shares and unlisted companies. But at the same time, obviously, our focus for that particular solution is definitely to try and mitigate as much of the risk where we can to deliver those steady, predictable returns.
Mm-hmm.
So wide range of options, but for both, the key headline benefits are it's exempt after 2 years, you retain access and control, and they are relatively simple because they are just investments. It doesn't involve trusts or the complexities of trusts or insuring against it. And again, that could be something that does put some people off.
Definitely. So you've given us a good overview of all the different types of, or several different types of ways to mitigate inheritance tax. I know you've got some important other things that you just want to add as well, just to make it clear that obviously everybody does need to take personal advice. Everybody's situation is completely different. So take it away, Vince.
Yeah, absolutely. So it's just important to mention some of the key risks with these types of investments that I've referred to, that like what Blackfinch offer. I've already mentioned, AIM shares and investments into unlisted companies, will be regarded as high risk. So capital is at risk. You could get back less than you've invested, and it could take some time to access your capital, despite the fact that we've always been able to provide that regular liquidity so people can access it. It could take a while, and that tax rules, may change in the future. It won't be suitable for everybody. So again, I'll finish off on my key message all the way through this. Really important to seek professional advice from a specialist advisor in this area so they can assess your circumstances to see, how this may benefit for you.
Thank you so much for sharing all of that information with us today, Vince. I know lots of people will have lots of questions now about all different areas of inheritance tax, but if anybody wants to contact us as well, you're more than welcome to, and we can always answer any of your questions. So thanks again, Vince.
You're very welcome, and thank you for having me along.
Thank you. If you've enjoyed listening today, why not head over and join our Facebook group, The Money Compass.
And if you have any questions for myself, Lucas,
or me, Emma,
drop us a message in this group.